Taxes. To you and I, they're about as avoidable as eating and sleeping. But what if I told you that there was another way? A way to live your life tax-free. To live a life of luxury, decadence. A world where every dollar you earn was a dollar in your wallet. A world where only one thing matters: running from the government. Tax evasion is the illegal evasion of taxes by individuals, companies, and trusts. It involves deliberately misrepresenting your affairs in order to reduce your tax bill, more formally known as your tax liability. And it's done in a number of ways and might actually be more common than you think. Now, in order to understand it properly, let me quickly catch you up on the basics of tax. This is Jim. Jim works 9 to 5 in a bakery 5 days a week and his boss pays him $150 a day. But before he can use this money on food and rent, the government requires him to pay taxes that contribute towards maintaining the town he lives in. Jim's clothes, however, get pretty dirty with flour every day and he has to wash them each night before he goes back into work. This ends up costing him $10 each day. But because Jim incurs this $10 cost in the process of earning his salary, Jim only ends up with $140 at the end of each day. Thankfully, the government recognises this and allows him to claim the $10 as a taxable deduction, and therefore reduce his taxable income from $150 down to $140. But what does this actually have to do with tax evasion? Well, there are two ways that you can theoretically evade taxes: by declaring less income than you make, or claiming more deductions than you're eligible for. And one way to measure the amount that people are evading taxes across multiple countries is called the tax gap. Now, the United States Internal Revenue Service and the Australian Tax Office have very similar understandings of what the gap is. It is essentially the difference between what the tax office would have collected if there was no tax evasion and what it actually collected. And if you're wondering how much this negatively affects your country, then you'd be pleased to hear that your government likely reports what their estimation of the tax gap is. The United States last estimated that on average $441 billion was not collected on time. But I'm not trying to evade taxes, I just didn't lodge my tax return. Well, once you factor in late payments and the government tracking people down, this tax gap was reduced to $381 billion on average between 2011 and 2013. But in order for us to truly understand the magnitude of this problem, we need to compare it to other countries around the world. And as you can see here, the US, Australia, Canada, and the UK all have large tax gaps equating to billions of dollars in uncollected revenue. Between these four countries, an average of 10% of the cash that should have been collected to fund your country goes into the pockets of people either misunderstanding or maliciously misrepresenting their taxes. Now, let's put that into some perspective. The US between 2011 and 2013 had a tax gap of $441 billion. That's over 55% of what they spent on their National Department of Defense, or about 74% of spending on public elementary and secondary school systems. So it's obvious that people are successfully evading taxes. But how is it actually done? Well, after researching into the topic, I realized that there are two types of tax evaders: those who unintentionally evade taxes and those directly deceiving the government. Underreporting income is the largest form of tax evasion. Receiving a job from an employer that is off the books or under the table could mean that taxes are being evaded from both sides. Now, in itself, there is nothing illegitimate about being paid in cash. But because cash is very difficult for governments to trace, people often aren't as honest as you'd hope. Jobs that are paid in cash give employers an opportunity to dodge their responsibility to pay employment-related taxes, and similarly, cash jobs give employees an opportunity to underreport their true income. In fact, the IRS estimates that restaurant waiters and waitresses underreport their cash tips by on average 84%. Now for some, this might be purely by mistake. But what about those that are intentionally hiding money? People participating in illegal gambling or organised crime are required to pay taxes. In this case, these criminals might hide their income and evade taxes through a process known as money laundering. Put simply, money laundering is a process of disguising illegitimate income as legitimate income. Money can be cleaned in a number of different ways. A common method involves the use of cash-intensive businesses. By mixing legitimate cash transactions with fake cash transactions, criminals can slowly convert an illegal cash stockpile into undetectable business revenue. Common examples of cash-intensive businesses include salons, car washes, arcades, and bars. And it might not just be hardened criminals that are hiding their money. Anyone could theoretically report to be making less income than they actually are. However, with the advancements in internet banking and online reporting, it is becoming more difficult. As stated on the Australian Tax Office website, some organisations such as banks, employers, health insurers and other government agencies have a legal obligation to report your information to us so that it can be used for taxation purposes. This is part of a scheme known as data sharing. You may have noticed that it's becoming easier for you to lodge your tax return, with some income already filled out in an online form. If you report a figure, however, to the tax office that differs from the amount that your company has reported, then the tax office might be concerned that something seems fishy. And speaking of things that seem fishy, there's an incredibly important distinction that needs to be made. We've been discussing tax evasion, the illegal misrepresentation of taxable income. Legal tax minimization or tax avoidance, on the other hand, involves using legitimate tax policies to minimize your tax bill. However, while it may be completely legal, it isn't always ethical. Some major corporations are involved in a process known as base erosion and profit shifting. This is where entities shift income from high tax territories to low tax territories known as tax havens. Common tax havens include the Cayman Islands, the Bahamas, British Virgin Islands, and Ireland. In fact, Ireland may be the most common tax haven used by the big technology giants. Put very simply, by shifting the ownership of intellectual property, IP, like patents, trademarks and copyrights, to a subsidiary company set up in Ireland, these companies are able to effectively shift profits from higher tax zones like the United States to lower tax zones like Ireland by charging their US operations a fee for using that IP. So, as you can see, this is a major problem for countries seeking to fund development through corporate taxes. Countries, in response to this, have implemented anti-avoidance rules that seek to prevent the deliberate reduction in taxes through legal agreements. Now, that's just a quick introduction because legal tax avoidance is really a whole other topic for another video, so check to see if you're subscribed. So, what are the hidden secrets of the most notorious tax evaders? Well, when it comes down to individuals, it's simply down to declaring less money than you actually make or claiming more deductions than you're eligible for. Blatant, illegal tax evasion is simple and is becoming more obvious. Tax avoidance, on the other hand, is a whole other game. Thank you for joining the 1 Week Academy. We'll be seeing you soon.